Welcome, everyone. Thank you for coming to our Washington, D.C. live event, and delighted to have a great mixture of allocators, as well as industry experts and people on the buy side here, representing private assets and all assets. I'll just maybe check in terms of the five lenses with which we look at the markets. And we always try to bring it back to an investor portfolio because it's all very well to talk about macro terms and pontificate about what's happening. Particularly now, we do believe it's important to be plugged in, but not necessarily to be making changes on a regular basis, but certainly being alert to them. So this one is really just coming hot off the press. Given we are in Washington, D.C., I think it's quite relevant that we have geopolitics will be a big kind of a backdrop to most of this. And obviously, we'll have some close ear to the ground in terms of what's coming next, but we'll see. So the lens we look at are inflation, interest rates, geopolitics, equity markets, and then we look at other asset classes such as crypto, private assets, and always said with a view of how that looks in a portfolio. In terms of where we will be addressing each of these points today, inflation, we look at it whether it's in stealth mode, where we stand on inflation, both where we were heading before the recent geopolitical conflagration and where we are today. Interest rates are starting to look oily, as I've described it, because they're starting to really relate to the movement in oil and how they are looking a lot more volatile and not necessarily behaving in a rational way. Equities seem to be somewhat in a comfort zone, and we'll ask about that. Private assets, there's still a distinct chill in the air, and we're going to discuss whether that is merited or whether it is sometimes retail investors that are driving this panic around an area that is essentially not particularly transparent. So let's start with inflation. When I've done these live events for the past 2 years, we have gone around and spoken to audiences like yourself and asked them about their own experience of inflation on the ground, the consumer's experience of inflation. I think after this long period of doing these, suffice to say, the experience of inflation is very different from the headline that we're seeing. We know that consumers are hurting. We know that what we're seeing, when I mean by stealth mode, this headline here around America's sneaky inflation culprit. We know that services, that there has been, even before we start looking at airlines, that it has been steadily creeping upwards, most of this driven by labor. So even though the headline inflation seemed to be heading down, the consumer's experience would have suggested otherwise. They were certainly experiencing that. And that was what I got from, I'm not even going to put the question to this audience because I'm just going to take as a given that we all have experienced higher grocery prices and that is starting to, we're all noticing that. What I think is interesting, though, is just how the inflation picture started to change since the December meeting from the Fed. We saw that their expectations, if we look at the blue line for 26, the red line for 27, we could see that as the meetings moved forward closer to the present, we saw that GDP is now turning upwards based on the economy being relatively strong, but still not looking particularly positive for as we go out for 2027. It's certainly lower. The unemployment rate being lower, that's again a factor of the massive AI, whether they're AI driven or not, but the massive layoffs that we've already been seeing, as well as not being able to really trust many employment numbers at all. And then when it comes to core PCE inflation, this is important. The Fed is clearly expecting inflation to rise. So this is the core number. And then, of course, we know with oil that there has been this rise in that. So what has this been driving then? Well, really, in terms of volatility, this has been translated into more volatility on so-called safety assets. So looking at, this is just a Bank of England gilts, they've been trading at levels not seen since 2008. Even the Liz Truss debacle at the end of 2022 did not see rates hopping to where we are here. So government bonds are clearly now starting to look a lot more jittery, not just in the UK, but across the different markets. And so there's clearly a sense that, is this a safety asset any longer as we look at government bonds? I'm going to just move this so we can see the title a little bit. So why, we both mentioned energy prices. Why do energy prices matter? Well, clearly it is a non-discretionary part of expenditure for most consumers, particularly those on the lower left side of the K. And we know that the more they spend on gas, the less they have to save. So this is all, if we were to do a vibe check in terms of the consumer, all of this would translate into a much more challenging environment for the consumer. Then moving on in terms of stagflation, and this is where I will stop to ask for some feedback from you all. One of it's clear that I'm based in the UK now, and stagflation has been a headline in the UK for years, essentially. The problem in the UK was it did not have this resilient economy that we were seeing in the US. We did not have the base of that growth, the underlying. We did know we still had inflation. And in the UK, inflation was definitely starting to had not receded to the same degree. So stagflation was becoming commonplace as a condition. I know that Gerald has written about stagflation many times on LinkedIn. And the question that came up for us was, well, how do you insulate a portfolio against stagflation? You might be able to maybe build in inflation hedges. You might be able to clearly have a growth that we're in a boom or a Goldilocks situation. Your growth assets will take over. But what is it that the stagflation would mean? And the reason before I just move on to that, what I think is important is to look at the safety trades. If you think in a traditional recession, safety trades are likely to be your hedge and be your protection. What we can see, and I already showed the government bond chart, that has not been behaving like a safety trade. Gold has had its worst sell-off since the bear market in 2013. It has clearly taken a big dip since over the outbreak of Iranian tensions. And it is actually, I thought this was an interesting chart, suggesting that even gold was in a bubble as it was behaving like NASDAQ in the dot-com era. So if our safety trades are not exactly looking like safety trades, any thoughts on whether stagflation is something that we can actually factor in if it is stalking out there? Is there anything in a portfolio that can accommodate that? Gerald?
The general rule, real assets is what comes to mind, whether it's in liquid or illiquid form, but real assets generally come to mind.
For stagflation.
For stagflation.
Yeah. I think it's not a scenario we might have had in our kind of our scenario planning, perhaps, because it has been really since the 70s that we haven't had that head. So I think that's an interesting point.
So Chairman Powell last week in his press conference didn't label it stagflation, but he cited the two facts that remain. Namely, there is inflation running above the 2% long run target. So there is inflation. And number two, there are elements of anemic growth. Combined, that's stagflation. Again, he stopped short of calling it that, but he even checked himself. And in the note that you're mentioning that I published, he qualified it by saying, quote, perhaps it's just me, was how he qualified it. But he did define that, yes, we have inflation, and yes, we have anemic growth. Together, that means stagflation.
This is going to be, I think, the fact that it's only been relatively recent that it's rising to the fore. I mean, the spike here, it shows that it was actually more subdued and it's been spiking recently. This is not something that necessarily is built in to the economic expectations as we look at where investors are allocated. Most investors will have a heavy growth orientation in their portfolio. They haven't seen much in terms of bonds being interesting. They've been low volatility in bonds, but there's also been very little upside. So if bonds haven't looked good, now the safety trades I showed before have not looked good. And I would say this is where the interest rate trajectory is important, because some of these real assets might have been more or less appealing in a lower rate environment in relative terms. And that was maybe where we thought we were heading. And now if we're not heading there, do these real assets look as attractive in relative terms? Will they reprice?
You're touching on a great theme. If you look at growth assets and use stocks as a proxy for growth assets, we're way overvalued. The average price earnings ratio on the S&P 500 and the Dow, and all of us know this, all five of us, is between 12 and 14. That's a historical average for PE ratios. We're now at 20 odd, near 30. So the growth asset is already overvalued as a safe trade.
So that's, again, yet another gnawing away, which actually is why getting to the one of the real nub of the problem around private assets. Why has there been so much going into private assets? Because there's been either a ennui with bonds. There's been maybe concern. Remember, real assets does include real estate. Real estates look pretty woeful in terms of it's certainly been a buyer's market. If you're an LP, it's been not the time to be raising a fund, a good time to be calling your terms, I would think, in that way. So this is, I think, what's driven some of this movement into private markets has been really related to this relative to value.
And Carolyn's space is perfect.
Thank you. We were talking about real assets. I think just before we move in to have a more of a deep dive into private markets and just sort of get to what exactly is going on here. Just some interesting observations over the course of the week. Clearly, really watching Truth Social, watching geopolitics, a very jittery, reactive market, I would say at the moment. We can see the fear gauge in terms of the VIX has been quite spiking over the course of the week. It has recently come down. This was just captured yesterday, so this would have been post the Truth Social post about the 5-day pause. Veracity of that being challenged, I suppose, but at least that was clearly the mood and the direction that markets wanted to see. And then in terms of the 3 sessions, a fairly sideways ultimate outcome, but clearly a jittery behavior on the part of the stock market. So what I would say is I've generally observed that it has not been retail sellers selling into this. We were at Moneta, we obviously have clients that have retail equity exposures. And they have been relatively sanguine, relatively calm. They've seen Liberation Day. They've seen the rally back post Liberation Day. They don't seem to trust their ability to trade in and out, nor should they. So they've actually been quite calm in the light of this. Tried not to be watching week to week, which has been I think a sign of maturing there. However, where are we with oil? Well, clearly with oil, we've had Goldman looking at a much higher resting kind of heart rate for oil. And clearly even here, we're seeing the forecast being quite a bit higher, not long dated, but in the near term around that. So that is clearly we're reaching a breaking point with just in this past week with oil, because it's not just, we've seen last week we were speaking about the stockpiles being released. And we know that was kind of the valve, I suppose, the safety valve or the shock absorber for the oil price. Now we're seeing much more pressure from the oil consumers in the Middle East and Europe and Asia around the Strait of Hormuz, and suggesting that this needs to be resolved soon. So there's clearly a break point, and we know that this commercial impetus will far outweigh any kind of geopolitical ideological impetus. So that is heading down from the consumer. And then I thought this was interesting because we've spoken a lot about the lower end of the K. So I've talked about the K-shaped economy for years, because I think it's only getting more extreme, and it has never really resolved post-COVID. So I spent a lot of time worrying about the consumer at the bottom right-hand side of the K. But we all know that consumer doesn't really move the needle in terms of expenditure. That consumer is maybe the electorate that needs to be addressed with an affordability policy and change, but it's not that's not where they are moving the needle. What is really, in terms of our business, why our business and private wealth has seen such roll-ups has been this staggering growth of household net worth and number of households with certain net worth. And there were a couple of slides that I pulled out from this week's news flow around this, just in terms of the growth of household wealth. This goes right back to the 70s. We can see that the top 0.001% has seen this staggering outsized growth. This is on the right. And then the number of households adjusted for inflation above 100 million, already very high, but at the 30 million, that sweet spot, the really that where Moneta and other private wealth firms would operate and see the most growth, it's around that 30 million point. So quite a dramatic move in that. And then I think it's important to say, well, where is the stock market leverage being felt? And clearly that's being felt with the stocks. The top 1%, they own over 50% of their assets will be in bonds and stocks and mutual funds. Their other assets will be a much smaller share. Whereas when you're in the bottom, 50% is basically your family house, your home, which represents the lion's share. So not that much participation in the equity markets, but a growing participation in markets and in private markets in particular, which seems to be driving a lot of this, I would say, irrationality that we're seeing in private markets today. I'd love to hear any thoughts just on this phenomenon around the retail investor moving in, whether it's to traditional assets or some of the non-traditional assets like the private. I know over at ILPA, you probably watch this in terms of the the migration of private assets. Do you see that the media might depict it as a one-way street? It's just asset gathering, without guardrails. How do you see the industry?
Well, we can talk about guardrails even because we don't know yet exactly where the SEC is going to come out on this, specifically with respect to giving 401k savers more access to private markets. But we're still very early days. The fact that 401k plans today that have exposure to private markets is still in the very low single digits. So vast majority of savers in the United States do not have the ability to choose more exposure to private markets. So who's playing in the space today? It's Monetta's clients and a lot of folks like that. And they're more where they came from. So we know even the penetration in the private wealth channel, if you think of them as part of retail defined broadly, we're still early days even in that, even though it's growing very rapidly. So we see a lot of greater potential for growth here. And what does that mean, of course, for the institutional LPs that we represent? But I think the bigger point is there's a wave coming onto the shore, and we know it's coming and that there's nothing that will stop it. And it's going to fundamentally alter how private markets operate. It's going to fundamentally offer the returns outlook for private markets for everyone, retail investors included.
I think it's a really important point. This chart on the left is more important, I think, because it's a question of, well, where are people actually, how are they accessing it? The highly wealthy, the top 0.1%, they're probably not doing interval funds. They're probably going direct. They've got maybe co-investment opportunities. They're doing venture. They're above the minimum, say, for most private equity firms. So they're not in the kind of the target zone of what's being seen the sell-off. I would think it's the first movers, or the kind of the toe in the water is typically you would do a toe in the water through or a interval fund of some kind. And I'm just going to go down to the private market page, because I think this is the important part. If we're seeing this massive race out of private credit funds, and every day there's another marquee name seems to be kind of captured by the net of private credit question marks, and we see the high and mighty from the big banks suggesting that there's been this pattern recognition, comparing it to '08, that there's that the geopolitics is a distraction. It takes that sunlight off some of the private markets. They can go back to being in the shadows, where they're much happier, you could argue. We've seen a few, we've seen Jamie Dimon speak about cockroaches in private credit. So clearly there have been some high level voices suggesting that there's trouble afoot. The interesting part is it doesn't escape their own firm as well, as also captured by that. But who is making these redemption requests? That's my question, because if you look here across Apollo, BlackRock, all the kind of marquee names, Cliffwater, Morgan Stanley, quarterly redemption requests have soared in this first quarter. And it doesn't take anything. It simply has to soar above that kind of 5% level for it to be a break point in terms of that. Massive, I'd say, goodwill destroyed when that happens. We all know in '08, nobody ever forgets the firms that gated. We have a very long memory, I think, investment when it comes to that. But my question is, who is actually putting these requests in? And I'm going to come back to my own industry. I think it might be the financial advisors that are, because most clients are not engaged to a point where they are actually so aware of private credit that they even are concerned about it being in their portfolio or concerned about redeeming. That's a decision of the financial advisor. So what I've seen for the most part is if there's a trusting relationship, that level of granularity is not there. So is it the financial advisors that are chickening out here? We speak about TACO and everything else, but is it the financial advisors? Because I don't think this is coming organically from the individual. So if this is financial advisors that have less high conviction, this speaks to something far more problematic within the financial advice segment, because there is, I would say, we're generally getting better with not being hot money when it comes to retail. But either these have been missold, mismarketed, and that is a story as old as time, because this was happening in '08 as well, or they are there's a lack of conviction or understanding in the advisors actually recommending it. But I think that's the problem for these funds. I don't think it's coming from individuals that are buying.
I think one interesting aside, kind of along the lines of what you mentioned, is we see not only consolidation and asset gathering in the asset manager space, right, but also in the investment consulting space. particularly on the institutional side. We deal with an investment consultant who recently was subject of an acquisition. I know several over the last probably 3 months that have been swallowed up by these largely wealth distribution channels. And so my question would be, is there the possibility, a lot of times these wealth distribution channels are seeking partnerships with these investment consultants to get their expertise on private markets and get their research on private markets to then distribute to their underlying high net worth clients. Question is, I guess, could there be a disconnect in how those private wealth advisors are interpreting institutional advice from, say, a pension fund consultant, right? And then translating that down to their underlying clients. So it remains to be seen, early innings, but like I said, there's consolidation at both ends, at the advisory level and at the asset gathering level.
That's a fascinating point. It's always points, of course, to groupthink. When you have consolidation, you're going to have much more higher risk of that. And I would say that's very much true, because I made that transition from your end, the public fund side, to the private wealth side. And what struck me is the desire for income, which is a pretty basic advantage of private credit, almost doesn't exist on the private wealth side, because generally you're not going to look to your private credit portfolio to deliver income. There are generally there is still an income coming into the household, or there is you're looking at dividends or other ways of getting at that. So you think about private credit differently. There's no kind of expectation that you're going to do the Yale model, so you have to positively make the case. But that is an excellent point. But again, it gets to a disconnect and a lack of due diligence and lack of training, lack of understanding, which is problematic. I'd love to now turn to Jen again in terms of this is your world. This, whether it's the kind of the murmurs, and nothing really catastrophic has gone under yet. It's been, little minor catastrophes that have been contained. And they're large in pound and dollar terms, but they're not actually large in terms of the impact on the bank's balance sheet, perhaps.
Yeah, and we don't play, ILPA is not as actively engaged in the private credit space today, even though our members are all invested in private credit. We have not historically focused as much of our attention on this space, but I can tell you the institutional LP perspective on this is, it feels a bit overblown as a story, I would say, is how the LPs are talking about it. So it makes for great headlines. But does it actually point to, crumbling, rotting foundation in private credit? Or is this irrational behavior that might be the product of a disconnect and, mismarketing, mis-selling? Is that really what we should be more focused on? And again, I'd point back to the SEC. What is the SEC saying and doing about all of this? I've seen Chair Atkins speak at a couple of events in DC just in the last 3 weeks, and I heard zero on this. So really hard to know, as again, we're waiting for the SEC to come out with something more formal and more prescriptive vis-a-vis the executive order of August 2025. It was due February 3rd. We haven't seen anything. We haven't heard sort of a revised date by when Department of Labor and SEC and Treasury will come forward with something. In our conversations with the SEC, we know that they are cognizant of the need for guardrails and education around liquidity, education, but also guardrails around valuations. These are really fundamental issues that have to be solved if you're going to open the gates, no pun intended, to a lot more capital, and even, I hate to use the word sophisticated, but capital, let's say, that is relatively underinformed to institutional capital. So it remains to be seen what those guardrails will be. But for now, it's in the press, it's in the headlines. And so it is the fact that those who are much further removed from all of this than all of us are reading these stories, and it's creating an impression in their minds. It's not good for private markets at all, because there's no countervailing voice, right, to really address, as you are, what's going on. And my question, even for you, is, so if it is the financial advisors who are really behind this, and they're pushing for the redemptions, and they're getting those up to the 5% threshold, well, where is that capital going? Is it going into cash?
Well, that's a great point. I suppose until they actually get it out, it's not going anywhere. But I suppose I think that before addressing that, I think that is another important thing. point about private credit is nobody really knows what's going on. And never mind the practitioners, the institutional consultants, there is a veil of opacity there, which is deliberate, because it's deal by deal, it's nuance by nuance. It's not a blanket contagion. So how on earth can the retail investors all of a sudden decide that it's a sell-off? And on the other hand, it seems like a classic example of them being the getting stuffed essentially at the end of the distribution chain, because we have, even I think Blackstone and KKR, people chipping in employee money. Clearly they think this is money good. So who is the one that's selling, crystallizing losses? It's that person putting the money in. And where is it going? This is a good question. I sat in an investment committee yesterday, and we did have a rebalancing question. It was actually generally what's happened is equities have got too high, have got out of range. Rebalancing comes in. Where do you rebalance into? Private credit just looks a bit questionable given what's going on right now. Real estate has not looked good for you. You'd have to have a very, I'd say, high conviction to invest in real estate today. It's a challenge to find an area that is actually compelling today. You might do infrastructure because you believe in that return stream, but that again, no retail investor needs an infrastructure return stream. My sense is, where's the money going? It's going into cash right now, because as interest rates being where they are, it's still decent, and it's probably going to be dry powder for some bottom fishing on equities again. So it's not there's no very compelling to go. From an institutional standpoint, if you were rebalancing in a public fund, where would you go?
Yeah, I mean, again, we do think about real assets. We had moved away as a pension fund, and due to environmental concerns from our municipality, our state, the country, we moved away from kind of the traditional oil and gas into some renewables and infrastructure. But now looking at it and looking at the long-tailed energy transition, might some of those assets be somewhere to rebalance into? For your retail investor, obviously, you probably don't want to be chasing commodity risk, but at the same time, as the need to pump more oil, kind of get certain assets back online as they deal with the mess created in the Middle East and the Straits of Hormuz, then might that be a decent time filler to put your capital in a rebalance situation into?
And I'd say non-US investors would definitely be doing non-US equities at this point as a rebalance, just part of that rotation, the growth to value, the US to non-US, the tech to other sectors. That rotation is still, I think, quite a big theme, and it seems to have merit in terms of valuations. So we're seeing that. Well, I think, go ahead.
Sorry, before you move on, and to address the point that Jen, you raised, the Genius Act and the Clarity Act that the Congress passed last summer, followed by the executive order in August, creates a moral hazard that we haven't foreseen. And I can label that moral hazard in two terms: sense versus suitability. Just because you open the avenue, the opportunity to allow retail investors into the alternative space, especially the illiquid alternative space, doesn't mean you should. There's a reason why we have so-called accredited investor status, sophisticated, as you said. There's a reason why we have those things. Retail investors have never experienced things like lockups, gates, J-curves. They don't even know what those things are. And just imagine if your ma and pa or grandma and grandpa, as a retiree or as retirees, being subject to capital calls with no distributions. And don't forget, positive IRRs and multiples are not guaranteed. So imagine an average household in retirement having to fund capital calls that they're contractually bound to fund, on the one hand, on the other hand, getting no distributions, and lastly, no guarantees of a positive return. That's the worst of all possible worlds. This thing hasn't been thought through well enough, I don't think. And I think Jen's instinct to have the SEC chime in on this more forcefully is right on point.
Just to pile on to that, I mean, I think even though we're early innings, to use the phrase Robert did, we're early innings on true retail investors having access to private markets. A lot of that to this point has been private credit. It has not been private equity, and private equity is fundamentally a different asset, different profile from a risk return perspective. The cash that comes in and the cash that goes out looks different. And so I think we're even more concerned about the private equity component in all of this. We talk about private markets. Obviously, it's not monolithic. None of us thinks that it is.
Yeah.
But everything that investors on the retail end of the spectrum have been conditioned to expect up till now has been primarily around private credit.
I mean, I think there's some interesting points. I brought up some other headlines just because this is a fast moving area. When we look at some of the, what else are we seeing? I'll just very quickly, obviously the dollar has been strong this when it comes to the cycling, the rotation, that may put a break on some of the rotation. If people think, oh, they've already, with the strong dollar for so long, been challenged with local currency investing in other countries. But that has been probably a reflection of just the military might. Winds of change in AI. I think there's some pretty interesting headlines around AI. One headline, I didn't even make it up here, but we know that there is rapidly changing, according to your particular rabbit hole you go into, rapidly changing AI functionality, concerns around governance, around use. Guardrails is an important word. We now have, we know that there are lawsuits out there around governance, around guardrails. We see AI trying to now narrow and really direct itself into the enterprise segment, just abandoning its video app. But the life cycle of that video app was extremely short, really. It was a big fanfare and then dramatic fall off in terms of its users. So I think that goes to show this faddishness that can come into AI at times, the other uses. The headline I didn't put up in this was the AI getting back to private equity, the promise of a 17.5% return in their latest round of fundraising to private equity players. I think there had been also Anthropic had also made some preferential terms, but hadn't been as explicit as guaranteeing a 17.5% return to private equity players. So that does smack of some desperation in terms of an ability to guarantee that, and would have to wonder and have to hope that the private equity players engaged in that bargain have done their due diligence extremely well. But there is a sense that the pace that's going on for AI is taking over. Has it reflected in the share prices, or in the hype and that concentrated block that is representing now the bulk of equity exposures? Not yet, really, I'd say, is the answer. I mean, it has still got a fundamental support. But this kind of growing concern and pushback, I think, is something that we're going to have to keep watching. Does anyone in the room have any concerns around the AI bubble? We've been talking for months about, is it bursting, all the interconnectivity, but it does seem that there's a sort of a pushback developing now.
You saw yesterday that HSBC, that giant bank, has officially appointed a chief AI officer. It's a new position. I hadn't seen it before. Watch for more.
Yeah, well, yeah, I think I've seen, and there's certainly the chief sustainability officer is probably getting canned now, and the AI officer gets in their place. But I thought this was interesting. I had this headline last week, but didn't have much time to discuss it. Jagdeep in University of California has now started to really frame AI in terms of risks. It's kind of a given. It's almost like that kind of Wi-Fi, in sense it's touching every aspect of the portfolio. But where are the risks? I think a lot of this gets to we talked about SaaS apocalypse and the trigger of that. And I think that was kind of an interesting way to think about AI as a risk, not necessarily only as an opportunity.
And I will tell you, this is absolutely the tenor of the conversations that institutional LPs are having right now about their private markets portfolios. Software is the biggest portion of exposure by sector that LPs have through private markets today. So even if they think they're somewhat insulated, relatively insulated from the SaaS apocalypse, they still have a lot of exposure to software. And so really beginning to set a higher bar and expectations of managers around how are they evolving in their sourcing and their diligence on deals and their ongoing monitoring, in their growth plans, value creation strategies, exit strategies around AI.
Yeah.
Because what I'm hearing is a lot of chatter from LPs that are pretty unimpressed and unsatisfied with what the rigor that they're hearing from managers around how they're thinking about this, as Jagdeep put it, through this risk lens.
Yeah.
So I expect to see a lot more on that risk tilt on the topic.
And I suppose it's a question of what is expertise. when we're dealing with so many unknown unknowns. How can we even be sure that a underwriting, to what standard, to what level can you be assured that a revenue projection or a customer acquisition projection is likely to be sustained? If we have something like a Sora that actually kind of is a boom bust, so some things do not in fact undermine Pixar or other kind of video creators. And then the other hand, we have this suggestion that two narratives around SaaS, that well, people will never abandon it, or equally it's going to be completely undermined. And Claude meanwhile brings out a new update every 5 days. So it's how could anybody know? I suppose is a question there. And just a couple of other points I thought were interesting to bring up. As we're all focused on kind of play by play around the Iranian situation, cyber, I think that's kind of clearly cyber insurgency, cyber security, cyber warfare. This is clear. We've seen it in terms of the Anthropic and Palantir and their uses, but equally we do know that this distraction creates a fertile ground for guerrilla warfare on the cyber front. We know that's how it's being waged on the kinetic front with drones, etc. So really the ability for AI has been the great equalizer in many ways, and arguably it is also going to equalize on a geopolitical front. So I think that's something that we need to think about. And then another point about the American economy and this resilience. I mentioned stagflation only recently entering the lexicon because it was just so strong. But whether this strength, which is in many cases being supported by these loyal stockholders, these loyal retail investors who listen to their advisors and don't sell. So that's what's propping up the stock market right now. Is this actually enabling an increasingly less predictable set of geopolitical moves? And probably I'd say yes. I mean, given the market is unrealistically strong, does that suggest that we're not actually seeing the natural fallout of some of the oil crisis certainly, or elsewhere? Are we getting a kind of is AI still bailing us out in this way because it's the AI story at the same time? So that may be one of the last points to discuss, I think. But
I think it's interesting too with midterm elections coming up.
Yeah.
Obviously it's some time off, but with the Republican Party in power, obviously there have been, I think we can agree, a number of missteps geopolitically, economically, day-to-day living, life-wise, that they have made, from a leadership standpoint, and yet the market remains incredibly resilient. Question is, in the midterms, can the Democratic Party even put forth that, hey, maybe even a more radical leftist liberal type agenda might not have an impact on the economy, just like a far right, kind of misstepping agenda has not affected the economy. So the economic picture becomes much more divorced from the political one. And I just wonder how that'll play out in the midterm elections.
Yeah, that's fascinating. Main Street, Wall Street. I think Main Street has increasingly been left behind. The occasional kind of circle through with an affordability campaign. And we saw that in New York City, and we're seeing that in other kind of populist elections. But I think that's an excellent point. And I suppose maybe as we strip away, as the consumer, as we strip away the shock absorbers, though, because the other shock absorber, which is really, it's not really absorber, but the other gnawing concern that's hiding in plain sight is the budget deficit. And that is, I think, why we do have this much more volatile approach to why we're not seeing government bonds as that safety trade, because there's a sense that we now, even a war is expensive. And this is, again, funds that are, really astronomical in terms of their impact on the deficit. And these are, meanwhile, they continue to rage. So that is only going to be more impactful on the deficit. So a lot of, I think, we're stripping away some of that, some of that, the security, or some of the kind of the fail-safe. So I think that is probably, in terms of the comments, all that I had prepared. I'll bring this to a close.